In this video, we delve into the intricate relationship between the U.S. stock market and gold prices, two critical indicators of economic health. The performance of the U.S. stock market often serves as a barometer for investor confidence and overall economic stability. When stock prices rise, it typically reflects optimism about corporate earnings and economic growth, which can lead to a decrease in gold prices as investors shift their focus towards equities. Conversely, during periods of market volatility or economic uncertainty, gold often shines as a safe haven asset, attracting investors seeking to preserve their wealth. Recent trends in financial markets have shown fluctuations that could have significant implications for both stocks and gold. For instance, rising inflation rates and geopolitical tensions can lead to increased demand for gold, while a robust stock market may signal a preference for riskier investments. Understanding these dynamics is crucial for investors, as they can influence portfolio strategies and asset allocation decisions. By keeping a close eye on the interplay between these two markets, viewers can better navigate their investment choices and anticipate potential market shifts. As we explore these themes, we aim to equip you with the knowledge needed to interpret these economic indicators effectively. Whether you are a seasoned investor or just starting, grasping the relationship between the U.S. stock market and gold prices is essential for making informed financial decisions. Join us as we unpack these concepts and their relevance in today's ever-evolving economic landscape. Over the last century, the relationship between gold prices and the stock market has been shaped by various key historical events that have influenced their dynamics. For instance, during the Great Depression in the 1930s, stock markets plummeted, leading to a surge in gold prices as investors sought refuge in this safe haven asset. Similarly, the 1970s experienced significant inflation, driven by oil crises and economic instability, which propelled gold prices to new heights as investors looked to hedge against currency devaluation. Systemic financial crises have also played a crucial role in affecting the gold-stock ratio. The 2008 financial crisis is a prime example, where stock markets experienced severe downturns, prompting a flight to gold as a protective measure. This resulted in a notable increase in gold prices, highlighting its role as a hedge during turbulent times. Inflationary periods have consistently impacted gold prices, as seen during the late 1970s when inflation rates soared, causing gold to reach unprecedented levels. More recently, the COVID-19 pandemic triggered massive fiscal stimulus and economic uncertainty, leading to a resurgence in gold prices as investors sought stability amidst market volatility. These historical contexts illustrate how gold and the stock market interact, often inversely, during times of economic distress or inflation. Understanding these patterns is essential for investors looking to navigate the complexities of financial markets, as the interplay between gold and stocks can provide valuable insights into future market movements and investment strategies. In the current economic landscape, the relationship between gold prices and U.S. government debt has become increasingly significant. As the government's financial health deteriorates, characterized by rising debt levels, gold often emerges as a preferred asset for investors seeking security. Historically, there has been a strong correlation between gold prices and government debt. As debt increases, concerns about inflation and currency devaluation grow, prompting investors to flock to gold as a hedge. The implications of rising government debt are profound, as they can erode investor trust in the stability of the economy. When debt levels soar, it raises questions about the government's ability to manage fiscal responsibilities, leading to uncertainty in financial markets. This uncertainty can drive up gold prices as investors seek to protect their wealth from potential economic fallout. Moreover, today's economic indicators differ significantly from past inflationary trends. While previous inflationary periods, such as the 1970s, were driven by supply shocks and geopolitical tensions, the current situation is influenced by a combination of pandemic-related disruptions, supply chain issues, and expansive monetary policies. These factors have created a unique environment where inflationary pressures are coupled with unprecedented levels of government debt. As a result, the dynamics of gold prices are evolving, reflecting a complex interplay of economic factors. Investors must remain vigilant in monitoring these trends, as understanding the current economic situation regarding gold prices and U.S. government debt is crucial for making informed investment decisions in an increasingly uncertain financial landscape. As we look ahead, several potential future scenarios for the U.S. economy could significantly impact both gold and stock markets, particularly in relation to government spending and taxation. The The first scenario involves increased government spending without corresponding tax hikes, aimed at stimulating economic growth. Under the current administration, this scenario seems plausible, as it aligns with ongoing efforts to boost infrastructure and social programs. Such spending could initially bolster stock market performance, but may lead to inflationary pressures, driving gold prices higher as investors seek protection against currency devaluation. The second scenario is a balanced approach, where the government increases spending while also raising taxes to manage debt levels. This could stabilize the economy in the long run, but the immediate effect might be mixed. Stock markets could react negatively to tax increases, while gold prices might remain stable as inflation fears are mitigated. A third scenario involves austerity measures, where the government cuts spending and raises taxes to reduce debt. This could lead to a contraction in economic growth, negatively impacting stock markets. However, gold might benefit as investors turn to it during economic uncertainty, viewing it as a safe haven. Lastly, a scenario of prolonged economic stagnation could emerge, characterized by low growth, high debt, and persistent inflation. This would likely create a volatile environment for both markets, with gold prices potentially rising as investors seek security, while stock markets may struggle to gain traction. Each of these scenarios presents unique challenges and opportunities, underscoring the importance of closely monitoring economic policies and their implications for investment strategies. In the current market context, incorporating gold into long-term investment portfolios is increasingly important for diversification and risk management. Gold has historically served as a hedge against inflation and economic uncertainty, making it a valuable asset during turbulent times. Investors should consider allocating a portion of their portfolios to gold, as it can provide stability when stock markets experience volatility. Recent trading decisions in the gold market have demonstrated this principle. For instance, many investors who increase their gold holdings during periods of economic instability have seen positive outcomes, as gold prices surged in response to rising inflation and geopolitical tensions. Moreover, the recent trend of central banks accumulating gold reserves further underscores its significance as a safe haven asset. This institutional demand can bolster gold prices, making it an attractive option for long-term investors. However, it is crucial to remain aware of market conditions when making investment choices. Factors such as interest rates, government policies, and global economic indicators can significantly influence both gold and stock market performance. Investors should adopt a balanced approach, regularly reviewing their portfolios to ensure they align with current market dynamics. For example, in a rising interest rate environment, gold may face downward pressure, while stocks could benefit from improved corporate earnings. Therefore, staying informed about economic trends and adjusting investment strategies accordingly is essential. By considering these insights, investors can make more informed decisions that enhance their portfolios and navigate the complexities of today's financial landscape effectively. In this video, we explored the intricate relationship between gold prices and the stock market, highlighting how these two critical economic indicators often move in opposite directions. We discussed how fluctuations in the stock market can influence gold prices, particularly during times of economic uncertainty or inflation. Understanding this relationship is essential for making informed investment decisions, as it allows investors to navigate market volatility and adjust their portfolios accordingly. We also emphasize the importance of keeping an eye on economic indicators, such as government debt levels, inflation rates, and fiscal policies, as they can significantly impact both gold and stock market performance. By staying informed about these factors, investors can better anticipate market trends and make strategic choices that align with their financial goals. As we wrap up, we encourage you to engage with us. If you found this discussion insightful, please consider subscribing to our channel for more valuable content on investment strategies and market analysis. Don't forget to like this video and share it with friends or fellow investors who might benefit from understanding the dynamics of gold and the stock market. Your support helps us continue to provide quality insights and resources. We appreciate your engagement and look forward to bringing you more informative discussions in the future. Thank you for watching, and stay tuned for our next video, where we will delve deeper into the evolving landscape of financial markets and investment opportunities.